Vivian, your hot stock girl. Today we're reading your comments. This is episode 4, so let's just go straight into it. So the first comment we have is by Gregory, and he says, "Hello Vivian, been investing for about a year and a half. Never really understood the stock market, just been playing around with my extra money. You are starting to clarify things for me. Thank you. If you can do a video on AMD, I think that'd be cool." Okay, so I already did a video on AMD. I do like AMD. And by the way, welcome to the channel and welcome to the stock market. I think you're gonna like it, and I hope the more you learn, the more successful you become. So yeah, I did an AMD video and I'll link it below. Next comment is by Devlin. "Do you think the market will continue down or gain back the losses in the next few months or years? I have 60,000 in various stocks. I was up 7%, but at the moment 3% negative. I'm thinking about selling if I can sell at break even." Okay, so you have to look at the market long term, and I'm talking about like 5 to 10 years out. You can't play with scared money, you know? If you think you're ready to get out of the market, then by all means, hey, do it. But I see it as, even if we do go through a recession, it's going to be a quick one, and it's not going to be as bad. And eventually the markets recover. I mean, look at the last recessions, the market recovered. Not all stocks recovered, but the market did recover. So yeah, if you want to sell and break even, go ahead, but I see it more long term. Okay, next comment, we have Thomas San Francisco. "Basically, I agree with your take, but trading cost is not an issue with an established investor anymore. Robinhood may not give you the best execution or price for your buys or sells. I also understand Robinhood pays broker rebates. Robinhood is in it to make money too." You're right, bad execution costs more money than just trying to save $5 on Robinhood, so I definitely agree. Next comment, I can't pronounce your name, I'm sorry. Deveranzi84. "What do you think of the Chinese policy on censorship when considering Weibo?" So I'm not a fan of censorship, but unfortunately the government can do as they please. Having said that, I do see Weibo as a growth stock. Next comment, we have TheScum. "Can you please explain why is it that a price above 17 times EBITDA is considered a growth numeration? And second question, is it industry relative or applicable across the board?" Okay. "Professional investors look for a rate of return on future cash flows. A higher EBITDA multiple indicates to an investor that there's going to be a lower rate of return. To compensate for that lower rate of return, you want fast growth from the company. And 17 times is more than double the industry average, which is 8. That's why 17 times is a growth multiple. And as for is it industry applicable or relative, for the tech industry, it's a lot higher. The EBITDA multiple is a lot higher. So, yeah." Okay, next comment is Tadka. "Can we buy stock from Chinese stock exchanges? I think foreigners weren't allowed to own Chinese companies. As far as I know, no. You can buy American depository receipts here in the US for big companies like Alibaba, JD, Baidu, but no, as far as I know, yeah, you know, you can't do that." Next comment is by Lydia Santiago, and she says, "You're a hard worker. Are you thinking of making YouTube a career?" Okay, so I'm fully invested in what I'm doing, and I love making videos for you guys. I love this community. I love, you know, sharing my knowledge with you guys. So right now, I really love YouTube, and we'll see where it goes. Okay, next comment is by Thomas San Francisco, and he says, "I think Microsoft will survive and do okay when you factor in its growing dividend. Like many large cap stocks, the old saying is that trees don't grow to the sky. Dividends are nice because they return capital to the shareholders. Personally, I don't like dividends because I like the company to grow its capital by using it, not by giving it back. But that's just my personal preference, because the company does grow a lot faster and you earn more as a long-term investor if the company uses that capital to grow their business. But hey, yeah, I know people like dividends, so that's cool too. think they're coming over here. Okay, so the next question we have is by Reginald Preston. Are you related to Financial Education Channel? Are you his wife or something? Okay, so I'm not related in any way to Financial Education Channel. I've never met him. I'm not his wife. I'm not married. And I just kind of watch his videos. I've been watching it from the way beginning, you know, back when he first started. So yeah, I'm not related to him in any way. Next question is by Robert Frank. By the way, Robert Frank, you leave very good comments, very thought-provoking comments, so I like your comments. Okay, and you said, I wouldn't invest in FITBIT because I don't believe in the product. With electronics, all the profits go to premium brands. The discount brands are commodities. The premium brands are pushing limits of technology and keeping society moving forward so that they have staying power and pricing power. I agree. Like you, most of the things you say, I agree with. You have great insight. So just a hypothetical question for you guys, just because I thought of it just now. If you had to invest in Fitbit or GoPro, which one would you invest in and why? I want to see that in the comment section below. I think it's an interesting perspective, because right now they're kind of the stocks that are not doing so well right now, and kind of, I'm not going to say hated, but you know, out of the two, which one would you pick? So that's about it. That's all the comments I have for today for episode 4. I hope I answered all of your questions and kind of entertained you for Sunday. And yeah, I hope to see you in my next video, and we'll continue the discussion from there on. So yeah.